Vikas Goel is now joining in. He's the managing director at PNB Gilts, here to talk a little bit about their muted set of numbers. Thanks so much for taking time out. Just help us understand the numbers this time around. Your profits have fallen quite sharply. What is the reason for this? Can you explain the cost side?
Yes, of course. Thank you for having me on the program. Last quarter obviously was a major departure from quarter one. Couple of reasons. As you are aware, we deal in fixed income markets. We are a primary dealer in fixed income markets. Therefore, our primary risk is interest rate risk. So last quarter, our commitment to the market, we increased our commitment to the market for two reasons. One was inflation was expected to trend down, and obviously there was talk of index inclusion in the air. Now, what really prevailed, to put it rather simply, was that on the index inclusion side, that view came out correct, but it was a classic buy on rumor, sell on fact. And post the inclusion news, yields actually went up rather than coming down. So that was unexpected, which obviously affected us adversely because we had enlarged our commitment to the market. Second thing was that market, rather than looking at Indian numbers, where inflation has been trending down, and that number is now obviously out, published September numbers, which was at that time expected, has come out to be more or less lower than where Reserve Bank and market expectation was. So that also was correct, but the market started focusing on a soft landing probability of US market increasing, which was reflected in their bond markets, where the inversion, the 10-2 inversion actually reduced. So the curve started flattening, and 10-year yields, US Treasury yields started going up. And now, obviously, they have hit about 5%, as you are aware. So that affected our markets also adversely, where yields also started mimicking what was happening in the US market. And that was basically the net result. I mean, our commitment was high, and while the views turned out correct, but the market behavior was opposite of what we had expected.
3-4 months from now, the entire action in the primary market will reach to a different level as India will get ready for the bond inclusion, the global bond inclusion of JP Morgan. How will that change life for PNB Gilts? I mean, the liquidity will change, the entire impact cost will change. What changes for you because of that?
Okay, so let me answer that in two parts. One is the immediate next 2 quarters, and then the next year, because what we're referring to will start happening next year now. So in the next 2 quarters of this year, I think you have already seen the MPC minutes. Indian rates or monetary policy will continue to remain restrictive. Liquidity will continue to remain restrictive in the foreseeable future. That is one. And obviously, there is this geopolitical risk, which is new, which will impart volatility to oil prices, as a result, potential volatility to inflation outcomes in India. So the next 2 quarters, as far as we are concerned, we will be very conservative in our approach to market. Therefore, the results will not be as volatile as they have been in the past. We expect very muted outcomes because our commitment to the market will be muted. Having said that, now coming to the next year is looking, as of now, obviously there is a lot of uncertainty around views right now, as you are aware, globally as well as in India. But 2-3 things are there, which is a silver lining. So one is the index inclusion. So flows will start $2.5 billion a month from June onwards. Obviously, that demand will lead to hopefully yields coming down and prices going up, which is obviously good news for us. So we may participate indirectly in this outcome via our participation in the market, and directly we may have potentially some clients who come to us to fulfill their investment requirements by buying from us directly. That is one. And the second part is that hopefully next year at some point of time, this restrictive monetary policy will change course. and accommodation will start getting reinstated. In other words, rates will hopefully start coming down in terms of repo rate being cut, so on and so forth. Expectation as of now of market, which was originally when the market started out, there was a thinking that Q3 of FY24 is when RBI will start obviously reducing rates. Currently, it's anywhere between Q1 of FY25 to Q2 of FY25. So we have these two positives coming to us next year. So hopefully next year will be a reasonably good year for fixed income market participants.
So if interest rates peak out where they are, when I say interest rates peak out, bond yields they peak out where they are, could you see an HTM gain also in coming quarters? Because if the cycle pauses or reverses, automatically gains will start coming back?
Yeah, so that is true. We are a mark-to-market player, as you pointed out rightly. So obviously rates have peaked out. If rates start coming down, obviously it is good news for us. So if that happens this year itself, that will be good news. Having said that, like I said, our commitment to the market is now very conservative. So we want to preserve capital. The idea is to focus more on the opportunities available next year. As of now, we see limited opportunities this year. However, opportunities look slightly better and far more next year, as I said.
Well, great to have you on the show, and thanks for highlighting in depth as to how the quarter gone by has been and what lies ahead for PNB Gilts.
Thank you very much.